brand new week. I'm Nandita Khemka from the Money Control Studios. And of course, if you look at how the going has been for the market, it's been pretty good after the recent correction that we've seen. We've staged a very good comeback from there. Given the fact that we have seen 50% retracement from the kind of correction that we saw, 10% shave off from the highs, and from there we managed to recoup almost 5% of the losses that we saw in the recent correction. Of course, this morning the global cues aren't looking all that encouraging. The GIFT Nifty is hinting at a negative start. Although you have mixed cues to work with when it comes to Wall Street, but Asian markets are on the back foot this morning, given the fact that traders are eyeing political developments, in South Korea, France, and now Syria as well. So lots to watch out for. Of course, we are bracing for a mildly negative start this morning, but this week, 24,800, that's a crucial level to watch out for on the index, given the fact that most experts believe that that is a crucial congestion zone or resistance level on the Nifty. Lots of stocks in focus, the likes of Paytm, Ceat, Godrej Consumer as well. We'll take stock of all those stocks. We'll take stock of all your queries as well. So keep your queries coming in on our live feed. We'll try and take them up as well. But of course, before we move any further, let's quickly take a look at the top headlines at this hour. Wall Street closed mostly higher on Friday, with S&P 500 and Nasdaq each notching fresh record peaks after the latest employment report showed jobs growth bounced back in the month of November. Treasury yields closed at the lowest level in over a month. Asian markets start the week on the back foot amid political developments in South Korea, Syria and France. The GIFT Nifty is indicating a muted but negative start for the Indian market. Oil prices gain as concerns over weak Chinese demand are offset by rising tensions in West Asia following the rebel overthrow of Syrian President Bashar al-Assad. Gold, meanwhile, edges higher after US jobs report supports rate cut bets. And Syrian rebels seized the capital Damascus that sent President Bashar al-Assad fleeing to Russia after a 13-year civil war and 6 decades of his family's autocratic rule. Well, let's quickly take a look at the cues for trade then. On Friday, we snapped out of a 5-day gaining streak, but nothing to really worry about because we've seen a good up move. For the week, the Nifty was up almost 2%. The index rather, decided to take a break. But broader end of the markets were quite buoyant, with the Nifty mid and small cap indices outperforming on Friday and clocking an 11th straight day of gains. Of course, we had the RBI policy meet outcome as well that came out on Friday. Of course, we saw the RBI maintain repo rates but cut CRR rate by 50 basis point. That is expected to infuse liquidity into the system and help out banks as well that have been, facing margin pressure. Sensex and Nifty erased gains to end flat on Friday. The Nifty Bank Index was down 400 points from highs on Friday, and of course, as I mentioned, the broader end of the markets were relative outperformers. Markets gained for a third straight week, aside of that, if you look at the kind of gains we saw last week, it was the biggest weekly gain in 6 months. All sectoral indices except for FMCG saw weekly gains. PSU Bank, that was the top sectoral performer for last week. In terms of options cues, the Nifty PCR put call ratio fell to 1.03 vis-a-vis 1.24 levels. Stocks in F&O band, PVR, Inox and RBL Bank, these are the new entrants in the band list. Granules India, Manappuram Finance, these continue to be in the F&O band. But FIIs, fund flows in terms of that, foreign investors turned net sellers. In fact, they were net sellers to the tune of 1,800 crore rupees in the cash markets, while domestic investors bought shares worth nearly 1,700 crore rupees in the cash markets. But nevertheless, FIIs have, snapped out of the selling streak that we've been witnessing for quite a few months now. For the month of December, FIIs have pumped in over 24,000 crore rupees. Is this, a reversal of sorts, or, is this just a bit of a slowdown in selling in the Indian markets? Well, we'll figure it out and we'll ask our experts about it. But, let me first bring on board our technical expert for today and, decode the setup really and how it's looking for the coming week. Kunal Rambhia, who's a fund manager at the Streets, joins in. Kunal, great to have you on the show. It's been a 50% retracement on the index, right? the Nifty around that 24,700 mark. We had managed to clock that 24,800 mark, which was the swing high last week. For this week, what are the kind of levels, and 25,000? Do you think that's on the cards this week itself?
Morning, Nandita. Thanks for having me on the show. So yes, it's always great to come to Money Control and discuss about the views. And the previous month when we met, we had discussed about this correction as a buying opportunity. And the only reason for that was that from 2020 lows so far, the trend is absolutely intact and it was positive. And we were discussing about the support levels of 23,300 kind of levels. Nifty made a low at around 23,200 kind of levels, and it bounced from that level itself. I still feel it's a buying opportunity. I am expecting the Nifty to show us the levels of 25,500 by end of this month itself. That's by end of December. Trend remains positive. So buy on dip can be a good opportunity, a good strategy going forward. For now, the support is 24,350. Keep that level in mind and keep buying the dips. I think the stock specific moves are likely to continue along with Nifty index also.
All right. What about the Nifty Bank Index? Not very far from its record highs, right? 54,400 or thereabouts. That was the record high, 54,467 to be precise. And we are around 53,380 or so. Although we came off from highs, on Friday, but banks have managed to take the lead thus far in this leg of the rebound that we saw on the Nifty. A dash at that 54,000 level anytime soon? In fact,
Absolutely,
in today's session itself?
So I'm not very sure about whether we'll see the new high coming this month or this week or in today itself. But if you look at the overall formation on the Bank Nifty, it's been in sideways consolidating mode since June 2024. The support level was 49,750. And in this last 6 months, we have seen Bank Nifty taking the support at the same zone for almost 4 to 5 times. I mean, to be precise, on 21st of November itself, it made a low near to that level and it bounced. Now, going forward, we just have to keep two levels in mind. The first level is the previous high level, which is at around 54,400, and the June high, somewhere July high, which was at around 53,400. So, which is the present level itself. We have to be a little cautious near this zone. By any chance, if the Bank Nifty manages to surpass these levels, we might see banks outperforming, and the levels which we can expect on the Bank Nifty will be 55,250 to 55,300 kind of levels. I'm giving a broader picture on this. Okay, so at present, I think the support is placed at around 52,750. Consider that to be a good support, and buy on dip again on this index can make sense. But for now, it's near to resistance, so time to be a little cautious on Bank Nifty, bullish on Nifty.
Okay, little cautious on Nifty Bank. But if I talk about particular stocks on the Nifty Bank index, the likes of SBI, PNB, how would you really look at those now? Because PSU Bank index, did manage to outperform last week. Any trade that you will take? In fact, we have a couple of queries coming in on some of the banking counters. I want to quickly address them as we discuss the banking index. Naveen wants to know your thoughts on PNB, and I have a query on ICICI Bank for the month of December coming in from Ayush Khanna. How should one really navigate some of these stocks?
So Nandita, I'm very bullish on PSU banking space. As far as these PNB, the names of PNB or say IOB, South Indian Bank is concerned, I'm very bullish. So as far as PNB goes, the counter actually was somewhere trading here to 145, and from there we saw it coming down till 92. But on the weekly chart, interestingly, the trend remained positive. On the daily chart now, it has given the double bottom breakout, and that breakout was placed at around 108. The counter is trading right now at 110 itself. So with the stop of 103, one can initiate a buy on this. The first pattern based target can be 118, and above that the target can be 130 to 135 kind of levels. Now this is the the overall formation on the PNB from the 1 month point of view. So keep that time frame in mind. ICICI Bank, for the sake of it, is absolutely trending. Undoubtedly, yes. But this counter has failed to surpass 1350 zone since September. In fact, yesterday, that's on Friday's session, it made high of 1347 itself. So again, this is a time to turn a bit cautious on this. If counter manages to cross about 1350, it can be considered as a breakout and the beginning of a new rally. Otherwise, we might see some kind of profit booking on ICICI.
All right, that's the view on some of these banking counters, and I hope our viewers are satisfied with that answer, and it helps them navigate their holdings in these particular stocks. But just about 3 minutes to go for the markets to open. Want to quickly discuss some of the stocks that will be in focus in today's session in particular. Paytm being one, Singapore Paytm is going to sell stock acquisition rights in Japan's PayPay, for a little over 2,300 crore rupees or thereabouts. Of course, the stock is in news and it has been doing fairly well in the last 6 months. If you see, it has more than doubled. And, there are quite a few bullish views coming in on this particular stock as well. 997, that's the kind of level that it hit in Friday's trading session, 52-week highs. How is the risk reward really looking here now for Paytm?
So certainly unfavorable risk reward ratio for the new entrants, but if someone is already holding, then I would first suggest the trailing stop loss at around 850 levels. Now we go back to the historical data and check out in October 2023. This counter made higher near to 997 or 1000 levels, and from there we saw the decline till 285, 300 kind of levels. And this entire journey since listings till the bottom of May 2024 was downtrend. In this downtrend, the swing high was 1000. After making the low of 320 kind of levels, the counter is now back to 1000 levels. So at this point in time, there is a possibility of resistance. The counter may face some kind of profit booking or resistance. If the counter manages to close about 1000, I think then the next resistance is directly placed at around 1250. But otherwise, this is a time to turn cautious. We might see a decline till around 850 levels. Consider that decline as a buying opportunity and think of buying near 850, 875 kind of levels. I think the trend is absolutely strong. It might just continue for now. But at 1000 levels, at these elevated levels, I'll stay cautious.
Okay, risk reward unfavorable for those looking to enter now, but people who already have holdings, for them, of course, it's looking good. And if you want to really get into the stock around 875, 850, that's the kind of level to get into it at. But of course, just about a few seconds to go for the markets to open. A couple of other counters Kunal will be speaking about is, Ceat as well as Godrej Consumer. We will take stock of that, but just about looking at the pre-open, we are staring at a 40 to 50 odd point of a downtick on the index. In the pre-open, the broader end of the markets also not, looking all that great. It is, of course, going to be a negative start. We are bracing for that, as is being suggested by the GIFT Nifty as well. Yes, there you go. The first ticks are just coming in. We have started on a negative note, as I was mentioning. 51 point cut on the Nifty. The Sensex also down somewhere around 200 points or thereabouts. The mid cap index, although just around the flattish line at the current juncture. Bank Nifty, yes, further downtick here as well. 53,480 is where it's at right now. A 40 point cut coming in. But let's see what some of the other sectors are doing at the current juncture. Want to take stock of the Nifty PSU Bank Index. That was the top performer last week. It's down somewhere around 0.3%. If you look at some of the other sectors, autos, in the red, IT in the red, metals in the red. So most of the sectors are trading with a negative bias at the current juncture. No outperformance being seen. Still early days to say which sector will take the lead or whether or not we can stage a good comeback from these opening lows or not. But let's look at some of the individual movers then on the index. I want to see what some of these IT names are doing, because they saw good traction, last week and then kind of fizzled out. So today, Tech Mahindra is taking the lead. That's the top gainer on the index with 0.8%, kind of an up move. L&T, Bajaj Finance, Shriram Finance, SBI Life, HDFC Bank, Sun Pharma. These are some of the counters that are gaining traction in early trade. You have HDFC Life as well. So both the life insurers, HDFC Life and SBI Life, among gainers. Adani Ports, Adani Enterprises, these are also among the gainers. And some of the PSU names like Bharat Electronics, Coal India, seem to be doing well. What's not doing well is Hindustan Unilever, Britannia, Tata Consumer, Nestle. So all these consumption names are under pressure, and no surprises really. given the fact that the mid-quarter update that has come in from Godrej Consumer is hinting at a continuation of the urban slowdown that emerged as a trend in the second quarter. Godrej Consumer, of course, has warned of further margin pressure and single-digit volume growth. Muted volume growth, so to say. So yes, on the back of that, some of these FMCG biggies are reacting to it. HUL now down almost 3%, Britannia in excess of 1%, Tata Consumer, Nestle. These are some of the laggards. Aside of that, you also have Infosys, where stocks like Tech Mahindra and Wipro are doing well. Infosys is among the laggards. Eicher Motors, ICICI Bank, Inbank, Ultratech Cement, Hindalco. These are some of the other movers. But looking at the market open, Kunal, what would you be keeping on your radar? What would you like to recommend for viewers?
See, I'm very comfortable still with PSU banks. I think this, even if there is a minor decline, I think this can be taken as a buying opportunity. So the likes of IOB or South Indian Bank, as we discussed in the beginning, are looking good. At the same time, selective mid-cap counters are also looking equally good. So I think this minor decline, even if so on the screen, can be taken as a buying opportunity. Even the IT stocks are looking favorable at this point in time. So extremely bullish.
Okay, but one stock that I want to really discuss is Ceat. That stock is up and about, gaining speed, 7% up. Of course, the stock is in news. It will be buying Camso brand of highways, tires and tracks business from Michelin. The deal is valued at $225 million and is set to be completed within 6 to 9 months. With this acquisition, the company will be gaining global ownership of Camso brand after initial 3-year licensing period, and the move will of course broaden the product offering into construction tires for Ceat. Acquisition also aligns with the strategy to expand off-highway tire segment, and of course the off-highway tire segment already includes over 900 products for Ceat. Now Camso brand holds strong equity in Europe and North America, so it will give good traction to Ceat in these regions. Stock is reacting to it. It has hit a fresh 52-week high as well. That's correct. 3,330 is where it's at. 7.5% uptick. What would you do with this stock now? Is it a screaming buy, or should you be cautious? Because the stock has been witnessing good traction. If you look at the long-term charts as well.
See, again, Nandita, these counters which are in trend, we should always try to capture during the correction. Now, look at the historical data, June 2022, from where this entire trend started. The counter was trading near to 920, 30 kind of levels, and we got the first signal of initiating a buy near to 1150 levels. And since then, this counter is consistently making higher top, higher bottoms. At this elevated levels, again, as we discussed about Paytm, we will not be keen to buy Ceat at this level. It's unfavorable. It's offering unfavorable risk reward ratio, right? So wait for some kind of correction. The correction which we saw somewhere between September till November 2024, where the counter came down from 3250 to as low as 2700. I mean, such kind of corrections can be taken as a buying opportunity. So for now, if someone wants to initiate a buy, keep the levels of 3000 in mind. Though it sounds very far away from present levels, almost 10-11%, but I think that can be a good level to think of initiating buy for long term. For someone who wants to trade breakout and trade, momentum, can initiate a buy at present levels. Stop loss can be 3150.
Okay, that's the view. Risk reward looking unfavorable. You should look at these stocks in times of correction. But what about Godrej Consumer? Well, that is witnessing quite a bit of a correction today. 9% down on this stock. The quarterly update came in, much earlier, and it isn't, it hasn't really painted a rosy picture, because FMCG was already under a spot of bother, especially the ones with higher urban focus, right? And in reaction to that, we are witnessing a sell-off across the FMCG pack today. HUL 3%. You have other stocks like Tata Consumer, Nestle also feeling the pinch. But particularly for Godrej Consumer, has said that volume growth is likely to be flattish. Margin pressure is likely to sustain in this quarter as well. So 9% downtick. Any fresh breakdown on the charts, and what should you do? Because this stock, along with some of the other FMCG majors, has been in a downtrend. Look at the 6-month chart, down 20%. Even the last 1 month, the stock is down 8%.
Absolutely. So just look at the highs of September. the counter was trading somewhere near to 1500 kind of levels, and from there it's trading right now at 1150. Now in this correction, which is almost like 28% from the highs, if I just go back and check out even the historical data from 2020 so far, I think good level is now approaching. If the counter managed to reach near say 1075, 1080, I will consider this to be like a buying opportunity. For someone who wants to trade momentum again, this is an absolutely downtrend. So any bounce can be taken as a selling opportunity. But for someone who wants to go positional, I think 1075 to 1080 can be good level. Keep that level in mind. Revisit the channel at that point in time and check, whether the support is getting formed now. I think near to 1075, if the accumulation is seen, one can take this bargain buying opportunity from long term. And these are the counters, which we always wanted to keep in our portfolio during the bad times of the market. So yes, I think this is a time where we should be thinking of buying. I'm not denying the fact it's negatively trending right now. So for momentum trader, it can be sell on rise. But for positional, I think 1075 can be good buying opportunity.
Okay, that's the view on Godrej Consumer. The stock is down over 9% as we speak. Another counter that's on my radar, and before we come to queries, I want to get in your thoughts on a Biocon. Had been witnessing good traction, but in the last 5 sessions or so, it has seen some bit of a correction. You can say it's been under the weather, so to say. There is news flow. The company has got EIR with VAI status from US FDA for its Bengaluru unit. Establishment investigation report, that's the kind of it's kind of looked upon as a positive, right? But the stock is under pressure. The surveillance inspection was conducted between the 23rd to 27th of September. Would you use this dip to buy into a Biocon? And within the pharma pack, anything else that you like?
See, again, price discounts everything. So let's go back and check out the historical behavior. July 2024, counter made high of around 377. From where there we saw the decline. Similar high was seen somewhere in July 2024. Again, the third dip was during September, and now again, counter is struggling near 375, 380 zone itself. This, on the historical chart, you can say as a strong resistance. If the counter manages to close about 380, 385 kind of zone, I think then the fresh rally might just emerge and we might see the levels of 420, 25 kind of levels. But otherwise, from here, we might see a correction. Now, in this correction, I think we should be keeping a watch on 355 as a support area. Near to that level, one can definitely think of buying. Trending counter, absolutely strong trend, but near to resistance for now. So either it comes down to 355, we accumulate, or it crosses 385, we jump and buy at that point.
All right, that's the view on Biocon then. But let's look at some of the viewer queries that are trickling in. I want to get in your thoughts on VST Industries. This one is coming in from Maheshwar Bhanu. Although he wants to know your thoughts on a fundamental, he wants to know a fundamental perspective, but he has some holdings. 500 shares at the rate of 340 rupees a piece, and he wants to know if it's worth holding for the long term for a gain of 15 to 20%. CAGR. Fundamentals aside, on the charts, how would you look at VST Industries? Because cigarette makers did come under a fair bit of pressure, on reports that, the GST Council may look at a higher tax structure for cigarettes. Since then, we saw ITC, VST Industries, Godfrey, all of them reacting pretty negatively. It would, of course, impact, earnings growth as well. So VST Industries, do you think it's worth holding at the levels that Maheshwar is owning it now?
See, I have been tracking this counter very closely, even on the fundamentals front. So if you look at the profitability on the quarterly basis, then yes, the operating margin got impacted in the recent last 2 quarters, and because of it, the price also came down. Look at the price correction from 485 levels, it's trading now to 325. But if you look at the year-on-year sales growth, it's pretty attractive. And after talking to, listening to the management commentary, we are very positive on this company, at least from the long-term point of view. Now we come to the charts. If you look at the historical data from 2020 so far, the corrections were always severe, but this counter has never fallen below this 300 kind of levels. In the recent correction also, it made low near to 308.9 kind of levels. Right now, trading near 325. So from the long-term point of view, I think this is a perfect buying opportunity. If someone is not really worried about, that 10-15% kind of decline from the present level, once you start accumulating, keep the support level in mind, which is 300 levels, and buy near 300 to 325 in between this zone itself. I think in a year, we might see the levels of 385, 390 very, very soon. And if at all someone has, the appetite to hold the positional targets are 425 to 430. This is the in-house target which we have set on this.
Okay, those are the target levels. I hope that answers your query. But on that note, let's move on to the next query. I spotted a query on 5-star business. This one's coming in from Raj Nihalini, and he wants to know your thoughts on this particular counter. It had been under intense selling pressure, but in the last 1 month or so, it has been looking at making some kind of a recovery, although it has been fairly sideways. But it has been a good recovery if you see the last 6-month chart. 640 is where it's at right now, not very far from the 52-week lows. Any kind of change or reversal in the pattern that you've witnessed on the charts?
See, I've never actually tracked this particular company. I just opened the chart for the first time. Now, looking at the chart, what I can see is that counter earlier was struggling to give a breakout of 640. And after giving the breakout, actually counter went up to 880 levels, but then consistently taking the support at 640 itself. And present level is near that zone itself. If you check out the last 1 month behavior, the counter is in the consolidation of 630 to 660 kind of levels. Now, if someone wants to initiate a trade on such kind of opportunities, one should wait for the breakout near support, and that breakout level is 660. If the counter gives a closing above 660, then with the stop loss of 625, one can certainly initiate a buy. I am not very sure about the volumes on this counter, though it's looking very thin on the chart. But if someone is comfortable with the value, I think one can play on the breakout above 660 with the stop of 625. And the targets can be 750.
Okay, that's the view, and those are the targets to watch out for. But I can spot a query that has come in on an NHPC as well. I want to take it up, given the fact that there has, we have a report from CLSA on this particular counter, wherein they have an outperform rating, a target price at 120 per share. The stock is currently at 85 or thereabouts, and CLSA believes that it's an underappreciated and inexpensive net zero play. And it has, the decadal green growth is validated by FY24 to FY29 regulations. And of course, the company is gaining share in hydro, and new faster growth avenues are also emerging for this counter. Of course, PSU stocks have seen a good turnaround, especially around that Maharashtra poll result time, right? And a lot of these defense names, shipbuilding names, and even power names are doing well ever since. Looking at the charts of NHPC, it has staged a good recovery in the last 1 month. It has seen a good 7 to 8% kind of an up move. Triple digit moves or triple digit level, do you see that happening anytime soon? The 52-week high was somewhere around 118 or thereabouts.
118, that's in July 2024, and from there we saw the correction of almost 36%. Now we come back to the historical data again. Entire year of 2024, this counter has consistently taken support at 75, and that's not first time, that's been 3 times. And on the daily chart, we can see the double bottom formation. The breakout has happened today itself. And, during the session itself, the alert got triggered in the morning. So with the stop of 81, one can definitely keep eye on this counter. I think this is an absolutely trending counter so far. Unless and until it closes below 80 levels, the view remains intact. This can be a good buying opportunity. The positional targets can be 107 to 108 for now. Then eventually we have to trail the stop loss and hold the position because of trending nature of the counter. But it's amazingly poised for the positional traders at least.
Okay, that's the view on an NHPC. Quickly want to squeeze in a couple of more queries. Kanchan Biswas wants to know your thoughts on Raymond's, especially in light of its demerger plan. Do you track this particular counter and any kind of level that you'll be watching out for here?
So on the charts, yes, I've been tracking this counter, and the breakout is placed at around 1775. Counter tried attempting the breakout at least 3 times in last 3 months, so it was a failure. So wait for the closing above 1775 with the stop of 1575. Then one can initiate a buy, and the targets can be 2200.
All right, that's the view. That's the target level mentioned, 2200. Hope that answers your query. One last query then. This one was on a sugar name, Sri Renuka. Sunil Patil wants to know your advice on this particular stock. How would you play some of these names like Bajaj Hindustan and Sri Renuka? Anything that's your preference within this pack?
Absolutely, this is the only counter which I've been trading and tracking since long. April 2022 so far, counter has not fallen below 40 levels on a closing basis. All right, and recently also you can check out the bottom was somewhere near to 38, closing was again higher, and counter is now in momentum. Anyone wants to trade on the momentum, this is a perfect level. Initiate a buy at this level, stop loss can be 40, and the targets can be 49. Do take an exit near 49 because that's a strong resistance. But if the counter manages to close above 51 again, so 49 to 51 will be no trade zone. Above 51, we can expect the targets of 60. I'm very bullish on the formation of Renuka, and it's a clear thumbs up at this level.
All right, a clear thumbs up on Renuka, and those were the levels that you should be watching out for. That's been mentioned by Kunal. But with that, we've come to the end of the query segment. If you couldn't take up your query, keep them coming in. Tomorrow we'll try and pick them up. But Kunal would like to thank you for taking out time and joining in and
Thank
sharing
you so
your
much.
thoughts. As always, a pleasure, and I look forward to interacting again sometime soon.
Thank you so much.
Well, with that, I want to quickly take a look at the market then. We have turned fairly volatile, oscillating between, gains and losses. I did spot the Nifty trading in the green just, a couple of seconds ago, but now we are again in the negative zone, down 28 odd points at the current juncture. But Bank Nifty is managing to hold on. It has also seen a reversal from opening lows and, trading in the green at the current juncture. But the broader end of the markets, trading with good, gains, 0.4% up move coming in on the Nifty mid cap index. Mind you, if they end higher today as well, the mid and small cap indices, it will be a 12th straight day of gains for the broader market. But on that note, let me bring on board our next guest for today. Joining me is Daljit Singh Kohli, Head Equity, Roha Asset Managers. Daljit, great to have you on the show here. We've seen a good recovery, after shedding 10%, from lifetime highs. We are now, just about 5% off those levels. And of course, we've also seen a reversal of sorts when it comes to foreign inflows as well, at least for the month. Is it too soon to rejoice, or do you think it's just the start and the stage is set for a Santa rally as we head into the year end?
Good morning. I think to conclude so fast that things have all turned around and market is out of the woods, that would not be a good idea. Mainly because one has to understand, in any case, we did not fall also too much, no? So it was not that we were in such a bad situation. It was hardly a 10% correction in a period of almost 2 to 3 years. So that way, market has been resilient. I think the reason for this correction very recently was mainly because of the poor results. Q2 results were not so good, and so the crux now lies on the Q3 results. Most of the people are believing, we also are in the same camp, that probably Q2 was an aberration. There were a lot of things which, because of elections, there was some disturbances, because of weather-related issues, some disturbances in some areas. So Q2 did not pan out as it was supposed to be. If those things reverse, and if this festive season induced demand comes back, then probably Q3 should show some resilience. If that happens, then I think we are back onto the track. So important will be how things pan out in this quarter. Till date, as of now, when we talk to the managements, there is some recovery seen in some of the sectors. So we are hopeful that Q3 will be a good quarter. And if that happens, then probably full year numbers will be intact. In any case, FY26 is still, everybody is building in 10 to 15% growth. See, after 3-4 years of erratic movement in the earnings growth, sometimes too much positive side, sometimes too much on the negative side. this is the first year after 3-4 years after COVID that probably we have a normalized earnings year, where there is not too much of impact of one-offs, either any kind of war or any kind of political disturbance or any kind of medical problems, etc. So this time it will be more of a normalized year, and when a normalized year comes, then it is fair to assume that corporate earnings will grow at 15% to 20%. That is the long-term average. And if that happens, then we are in for a good ride.
Right. Of course, you said that some pockets would see a recovery third quarter onwards. And FMCG doesn't seem to be that quarter. Looking at the third quarter update that has come in from Godrej, top four losers on the Nifty right now are from the FMCG pack, and Godrej Consumer itself is down almost 9% or so. They have, hinted at margin pain and, flattish volume growth. And that has, kind of taken the entire FMCG pack down with itself at the current juncture. But the trend that emerged in the second quarter earnings was that of a slowdown in urban consumption demand. Do you think the third quarter update coming in from Godrej Consumer is hinting at this slowdown, lingering on in the coming few quarters? Because most of the experts were also of the view that, it's too early to really say that it's a trend. And most of them may have also said that, it's kind of bottomed out now and, it's just a one-off. But now, what would you really say, looking at the kind of update that has come in from Godrej?
Yeah, see, urban consumption has definitely been impacted, and the basic culprit has been the inflation. The high inflation has taken away disposable income from most of the people, and therefore we have seen a good impact on the urban consumption. But we also have to be mindful that urban consumption probably is changing the contours. No, normally the staples, the traditional way of looking at things, people are consuming the same kind of items every day. That may not be true anymore because of these online availability of so many things with these apps, and everybody is now trying new things. So it might also be that people are consuming things, but they are not consuming of the same brand. They're not consuming in the same way as they were doing 3-4 years back, 2 years back. They are probably trying out new things. And so that gets disbursed over a larger number of companies, which may be unlisted also, which may not be in the organized sector also. So that's why you may not be seeing those in the numbers of these companies. No, so that's why we have to be very mindful when we say that these are trends setting in, or one company number is giving us an indication. It may not stand true. I think that way of analysis has to change over a period of time, and most of us will also learn to this, get into this, that whether actually things are people have, is it the consumption has gone away, or is it has changed its shape, it has changed to some other thing. So we have to understand, in our perspective, in our PMS perspective, we are thinking where we in any case avoid the staples and these kind of large companies. We have mid and small companies, and we are very bullish on consumption, urban consumption, on luxury items. So high-end cars, alcohol, beverages, etc. Those kind of companies, some of them we own in our portfolio. We continue to believe that those are the companies which are growing at a significantly high rate than than what is shown in the numbers of these big traditional companies.
Right. When you talk about consumption, you can't really ignore these quick commerce companies as well, right? And now there are two players, listed players, and Zepto may come in, sooner or later. Would you own any of these? And given the fact that the valuation gap between Zomato and Swiggy, seems to be narrowing, Swiggy still has a long way to go, in terms of profitability, turning profitable. Any of these names excite you now? Zomato has had a fairly good run, and quick commerce for Zomato, of course, is doing extremely well, where Swiggy is, looking to play catch up, but that will take some time. So, any preference, and any of these stocks, are they already there in your portfolio?
No, so as a disclosure, they are not there in our portfolio, mainly because of the valuation part. We are very mindful of valuation at the point of entry. No, so whenever we are deciding to get into a stock, that time it should be a comfortable entry point. With these companies, when they started their up move, they were not making profit. And second thing for us is that they should be cash flow generating. So for us, it was at that time we didn't buy these companies, and then it's only the valuations have only expanded. So for that's why we have chosen to ignore these companies. But yes, they are all doing well. They are now. It has become a kind of a habit for everybody to use these platforms, and with this small platform fees, their mm, the earning numbers have just blown out of proportion. So they're likely to do well. Maybe at some point of time, once the entry point is reasonable enough for us to understand, and in our understanding goes well, then we'll buy it probably. As of now, we are out of these both these companies, uh, and but we are very bullish, as I said, on the high-end luxury part.
Right. How would you approach banks now post the CRR cut? Of course, that will infuse liquidity, into the system. 50 basis point CRR cut. Would that translate into, higher margins for banks immediately? And if yes, which are the banks that you would be looking at? PSU banks have been doing fairly well. HDFC Bank has, done well in recent times, taken the leadership, so to say. So within the banking pack, post the CRR cut, how would you look at it?
So things are turning around for them for quite a few months. Most of these banks were under pressure, both on both the sides. On the cost of funds going up, was this clamor for deposits, and then the asset quality also had shown some stress in most of these numbers of most of the banks. So we have avoided all these banks in our portfolio. Amongst the BFSI, we have housing finance and we have power financers. Both these niche segments, we feel that there is much more potential there. On the power finance, because there are only two power financers which cater to most of the demand, and both of them technically they are safe because government supports them. Second, so there is no NPA problem for them at least technically. And then these companies, there is a long runway for. We know that there is solar and all these various missions from government. So power financiers are in a good shape. Housing finance is always most preferred, most safest kind of route for most of the NBFCs and for the banks also. So and as with the cost of funds going down, it will be again, they will be beneficiaries. So instead of going with the mainline banks, we are going through these companies.
Got it, got it. Now, speaking about the mid caps, mid and small caps have seen a very strong recovery. In fact, they are marching back towards their highs, so to say. There have been concerns over valuations within the broader universe, right, broader market universe. But if somebody has to cherry pick from the broader end of the market within the mid and small cap universe, which are the pockets one should look at, and what should the approach be? Should one work with the bottoms up approach? Will 2025 be a stock pickers year? I mean, how are you looking at the new year now?
See, mid and small cap actually is always a bottoms-up approach because it is a very heterogeneous sector, no? So from what would you term as mid and small cap? From a company as small as 500 crore to 1,000 crore, 2,000 crore to 20,000 crore. No? Now, with that kind of variance, obviously the companies will have totally different way of working, management's style of functioning, the addressable market, the peer set, all these things will be totally different. So it's actually a misnomer to club all of them into one and say that mid caps are costly. No, this question keeps coming to us every day when we talk to our clients, when we talk to the new potential clients. They will always say that everybody is talking mid cap is so costly. So our answer is always that there are almost 4,000 companies. Will all of them become costly at the same time? The answer is never. No? Will all of them will be attractive at the same time? Never. There will always be some pockets of the market which will be froth, which will be too highly valued. There will be pockets which will be undervalued, which will be mispriced. So as a money managers, our job is to look at those opportunities. And we don't need 100 companies in our portfolios. We need 20, 30 companies. If we do our hard work properly, we will definitely find those 20, 30 companies at any point of time, wherever is the market. It doesn't matter. Of course, market has an impact on each and every stock. No stock works in isolation. But ultimately, what matters is the specific stock, a specific company, how they are generating their cash flow, how they are building their business, what is their growth path, what is their trajectory. So if you have worked on those parts, I think you will definitely get good ideas at any point of time. So generalizing which sector, which segment will do well, I think it is better to generalize which segments not to touch. No, then whatever is left is always there. You can find something from there. So what we are not touching is definitely PSUs, railways, defense stocks, anything which is obnoxiously valued, very high valuation, where companies may not be bad, but you have already paid them for 4 or 5 years. Then it means that either the time has to correct or these companies have to jump 4, 5 fold. No, either of the things happen, then we will obviously look at them. Otherwise, you avoid these. Rest of the space, you will find some good ideas in almost each segment. As I said, we are looking in alcohol. We have bought some company in a sari maker, sari seller in South India. We have a company in high-end cars. We have an wind power company, a castings company, which is into wind power. So it's a wide variety of sectors where we build our portfolio.
Aside of PSUs, any other pocket that's an avoid right now? And aside of all these pockets that you mentioned, from the large cap universe, what would you be looking at with a 2-year perspective? If somebody has to recalibrate their portfolio with a 2-year view now.
See, in our scheme of things, because as a mandate, we are looking for alpha generation, right? Now, when you want to generate a higher alpha, mega caps, large caps probably will not fit into that because they're already well discovered. They are too large to grow. So they will grow maybe 15%, 20%, 10, 15% kind of number they can show consistently. There are many good companies in large cap which will do this. But we are looking for companies which will have earnings compound of 25 to 30% every year. No? So CAGR of 25, 30%. So in the 3 to 4 years, they should develop their earnings. That kind of companies we are looking. So by nature, we have to look for companies which are small today and will become big. Now, amongst your question about what is fairly valued in large and maybe nifty companies, there are some companies where there is a lot of negative news flow. Oh, no. So disclosure, we are not investing and this is not a recommendation. So companies like paint companies, right now there is so much of negativity there. Companies like we talked about in state FMCG companies, where the valuation there are some finance companies in Nifty where profits have grown up 3 times in the last 2-3 years, but their valuation multiple is still the same. So those kind of things one has to look for if one has to stay in the top companies or large companies.
Point taken, Daljit. With that, we are completely timed out. Great to have you on the show and have you share your thoughts with us. Always a pleasure. I look forward to interacting with you again later this year itself. If not this year, then wishing you a very happy new year.
Thank you very much. Thank you. And same to you and your viewers also.
Thank you. Well, on that note, of course, we are timed out on this edition of Opening Bell. But looking at the market, we are pretty much where we started the day at 24,640 on the index, down 30 points or so, and the Sensex also down somewhere around 120 points. The mid-cap index, although, is showing strength, 0.5% gains coming in, outperforming their large-cap peers. The Bank Nifty also, just about trading in the negative zone, flattish at the current juncture, but off opening lows for the Nifty Bank Index. Of course, it's the FMCG pack that's feeling the pinch, and it's purely because of the kind of update, Q3 update that has come in from Godrej. Look at the likes of HUL, Tata Consumer, Britannia, Nestle, Trent, Asian Paints. So top 5-6 losers on the index are tilted towards urban consumption. And they are feeling the pinch, in today's session itself, reacting to the update that has come in from Godrej Consumer. But with that, completely timed out. I would like to thank everyone for joining us and watching the show. But of course, I'll see you at 3:30 p.m. Don't forget to tune in on closing bell. Till then, have a great trading day and stay tuned to Money Control for all your other news and updates.